Hi, this is Ashish Shanker, Head Investments for Motilal Oswal Wealth Management Limited. I am happy to take you through the next episode of our Know Your 4C Manager, where we bring our winning managers closer to you. Today we have a winning manager who's probably youngest of the lot. He passed out from IIM Calcutta in 2003, and for the last 4 years he's been managing the Motilal Oswal Multicap 35 fund. He may be young, but his performance is stellar, and this fund has done about 28% per annum since inception. So Gautam, welcome to the show.
Thanks, Ashish.
Last 4 years has been amazing for this fund. Could you talk us through, the thought behind the portfolio creation and what has really worked?
I think we have always believed in this maximum of 25, 25, 25. Essentially 25% ROE, 25% EPS growth over the next 3 years, and a trailing P of 25. Obviously, as you know, it's become over a period of time increasingly more difficult to achieve that. 25% ROE, of course, is a function of the quality of the stocks that you own. 25% growth at 25p today has been a challenge, but when we started, it was not, right? So getting a peg of 1 and buying quality stocks with very good growth, step back into April of 14 when we started, it was doable. So we did that, and thankfully after that we have seen a very good catching up of valuations of quality stocks, which were somewhat subdued because we are coming out of a bearish market then. So valuation catch up has really helped us. Thankfully on the earnings growth delivery front also, most of our stocks have done well. So, honestly, as a fund manager, the one metric that I have to constantly evaluate myself, my team on, is whether my earnings delivery is happening or not. Obviously, the quality of the stocks should also continue to be unbroken. So I'm very happy that earnings delivery has happened. So that is the core. That is the core engine which has driven performance. And going forward also, that is the one engine that we have to rely upon more and more to deliver the kind of performance that we aspire for. Of course, buying that growth at the right P has become a lot more difficult compared to what it was 4 years back. But that's why we keep saying that markets are not uniform. Markets are an environment where things keep changing. And there I will step back into something that Berkshire Hathaway AGM, Mr. Buffett himself actually mentioned, that look what happens when you can't get that 25% growth at 25p like we aspire for. He mentioned that in his context, that ideally he would love to buy a very, very asset-light business, high ROEs at a reasonable price. But if they are not available, then he'll go for the second best choice. So for him, it is basically slightly more asset-heavy businesses like Burlington is at a reasonable PE, and hence get a reasonable return. So tone down your return expectations, but keep them reasonable. Keep them still higher than your cost of equity. Keep them higher than the risk-free rate plus a risk premium. So in the Indian context, we would, as a thumb rule, say that there will be a 15% kind of a hurdle rate over a 3-year period. So going forward, if we can attain more than 15%, we'll be happy, and that's the kind of returns we're looking for, right? So while we know that aspiring for 25%, 25% growth at earnings growth at 25 trailing P is possible today, but then you get into the next best option, but which is still an acceptable option. So lower returns, but still an acceptable return is the mantra today. So probably today we're looking at more like 20% growth at the portfolio level, and the P's remain around at the portfolio level, maybe 23, 24, and that, mind you, is also because it's almost like a barbell. While we have a few stocks with 40, 50 plus P's, we also have the oil marketing companies which are like 8 P's. So it's a mix which is creating this average of 24, and that average can be misleading like all averages. But yeah, at the portfolio level, can we get a reasonable return from here based on our premise of 25, 25, 25, or as close to that as possible? Yes, we can. Acceptable returns we can, but not the stellar returns probably that we have seen in the last 4 years, that, as you know, has also come quite up-fronted, right? So while markets have been rallying, if and when there is a correction in markets, probably that will give you another entry point from which you can aspire for those kind of stellar returns. So it's also a function of the market construct, what kind of markets you are beginning your journey in. Thankfully, when we began, it was a very healthy market to begin in to get those kind of stellar returns. But the key point is, does your philosophy or your strategy of investing change with the market conditions? Simply it doesn't. You just focus on the best that you can make out of those.
I also understand that Motilal Oswal AMC has a very clear and unique philosophy of building the portfolio and managing money. Could you talk us a little bit through the philosophy and how do you apply it to the portfolio?
So essentially, investing in market is a very multivariate kind of experience, right? People might just focus on one thing like valuation. They might just focus on quality. They just might focus on growth versus not growth, just buying value. But these are very, myopic ways of looking at markets, because markets are multidimensional. And the four clear dimensions that we have identified are quality, growth, longevity. First, longevity is the longevity of the franchise, including the quality as well as the growth, and valuation, which is price. So I think between all these four variables, we pretty much capture what all can happen for a business and its price, right? There probably, to my mind, is no fifth dimension on which you can think about buying businesses for long term in. So that's how we capture, that's our mantra, QGLP. So, all these four words, quality, growth, longevity and price, essentially can be thought of as the four legs which is supporting a table. So if you have one leg missing, the table basically gets disbalanced. Equity markets stocks are based on these four pillars, and that doesn't change. That is actually very universal. We have adapted it, we have crystallized it, called it QGLP, and communicated it to our investors. And the important thing to remember is that as an investor, you have to get all four of them right. As I said, you cannot be myopic, you cannot forget price and just focus on quality. You cannot just focus on, let's say, quality. And many people have historically thought us to be like that, but that's so not true, because we are focused on all four aspects. We want to balance all four, and then and only then you can have an optimum long-term investment strategy, which is what we focus on. So essentially, for us, quality, we'd like to err on the positive side on quality. We would not like to be amiss on quality. Why? Because we are long-term investors, and the price of a bad quality over the long term can be horrendous, right? So we don't want to fall in that trap. Quality is a must for us. Growth, well, we are out and out growth investors, but if we find, especially in today's environment, a slightly lower growth company but at a very reasonable valuation, we're fine with that. Especially if we see optionality of that growth bouncing back in the future, like what we did with IT in the recent past, and we are seeing signs of optimism coming back into that sector, just to give an example. Again, longevity is very important for us because, being long-term investors, and if you want to build a scalable fund, you want to buy companies, stocks, where the runway of growth, the runway of the franchise sustaining and the growth is very long. Because what happens then is you don't have to churn, you don't have to sell out your positions, you don't have to, which itself limits capacity. If you have to frequently get out of your positions, get into new positions, that is a capacity limiting factor too, besides the hassle of overactive management. So we want to keep the activity levels at the stock minimal, and that's where longevity also plays a decent role. And somewhere that's a sweet spot, getting a good high quality compounder which you can hold on in your portfolio, like the private retail banks have been for a very long period of time. That gives a very stable core to your portfolio, vis-a-vis looking for the next high performing stock every 6 months, which is a much more tougher, it's like being on a treadmill where you have to run increasingly faster to be at the same pace. That's the choice we have made, that we'll rather go for the long-term compounders and stay clear of the treadmill business, right? And fourth, of course, is the price angle, the valuation, which is really important in today's context, where we know that market valuation, especially for the broader market, including the mid-cap and small-cap indices, are at very long-term highs.
How do you keep evaluating the price of every company that you hold? Because, most of us probably have a very simplistic way of looking at price, which is, let's say, a PE multiple or a price to book multiple. What is your definition of a reasonable price, or how do you evaluate it?
The valuation of any productive asset, end of the day, is the future value of the discounted future value of the discounted present value of the future cash. So whenever you are doing a valuation exercise, even if it's a thumb rule based one like a PE or a price to book, essentially you are doing a short form of that DCF that you have to do. The short forms work because the same kind of, let's say, ROE patterns and growth patterns would result in a similar PE. So you have that context in your contextual familiarity in your mind that, okay, this PE would ideally mean these kind of growth rates, this kind of ROE, and sustain over this period of time. PE ratios are definitely important, but what is also important is PEG, because if having bought a quality name, you want to see that what is the payback period, what is the PEG like, to be able to ascertain whether whether the stock is really very expensive or very cheap. So give an example, if you're buying a 40p stock, 50% ROE.
So when you say PEG, it's PE adjusted for the growth that you see in
the trailing PE adjusted for the forward 3 years earnings growth. So if you're buying a 40 trailing PE stock with 10% earnings growth, versus a 40 trailing PE stock with 25% earnings growth, next in the picture, the returns, potential returns would be humongously different. So I think the importance of growth versus PE is very important, and that is what we focus on a lot too when we are looking at valuation, especially in today's context where PE ratios are obnoxiously high in many cases, in many quality names. But the funny thing is the growth rates might or might not be different. As I said, 40p stock bought at 40p with 10% growth versus, let's say, a 50p even with 25% growth. I think the second one can give you a much better return. And that is something that is important to remember, although both look expensive, right? Because both are more than PEG of 2, but still, relative to each other, probably the second one will be a better option. So ideally, we would look for PEG with high quality of less than 2, where we can be reasonably sure that money can be doubled over the next 3 to 4 years. Even if it's 4 to 5 years, I think in today's context it's acceptable, but that's the broad framework that we live with.
You choose to run a concentrated portfolio. I know that as a house you're an advocate of ensuring that the portfolio is managed in an optimum fashion in terms of number of positions in the portfolio. What was the reason behind this approach, and are there any challenges of running a portfolio which is more concentrated?
See, as a very simplistic formula, the way to look at it is the maximization of wealth creation happens through equities as the number of stocks that you hold really comes down, right? So if you look at the list of all billionaires in the world, you'll see that most of them are like single stock, their own company. Of course, we are minority investors, so we cannot fancy being a single stock investor. Anyways, regulatory wise, we cannot do that too. Plus, it works well if you're controlling that business. We don't control the business, we are minority investors. As close to being like very single stock or very few stock as possible, but also optimize on the risk part and also allow for capacity and other issues. So, studies have suggested that the Sharpe ratio kind of gets optimized if you have a 20-25 stock portfolio. And that is where we try to be at, between 20 and 25 stock, maybe 1 or 2 stocks more than that, but not, let's say, 40 stock or not even 35 plus stocks. So that's our aim, to make sure that our risk return is optimized, and also we have enough capacity to deploy, because in markets you get multiple opportunities. Markets are like that. So it's not that we want to be a very, very extremely concentrated. We cannot do that for practical purposes. Neither is it that we'll ever be a very wide, very diversified 50 plus stock portfolio. So our happy space is 20 to 25 stocks where we think we can maximize returns for the risk or the volatility that we will have to live with in the portfolio performance.
Coming to markets, we've had a very interesting 2017 where all portfolios have seen stellar returns. In fact, at the index level itself, we've seen outstanding returns. Last 3 months have been a little turbulent. What's your take on markets going forward? We have an election as well round the corner next year.
The turbulence at the market level was expected, given the way the markets had gone up without too much of earning support at the index level. earnings are still to come through. It's expected that they will come in FY19, but we haven't seen earnings delivery been very strong so far. So some correction in PE, some moderation in PE levels, which by the way had really gone through the roof on the mid cap and small cap side, and even in select stocks on the large cap side. Large cap PE gets camouflaged because you have the likes of the PSU banks and maybe some metal stocks or oil and gas companies, OMCs, which are very low PE. So the average again presents a very different picture from the actual individual numbers, right? Even on the large cap side. So high valuations have been a very, very strong trend in this rally. Maybe unlike many other rallies which we might have seen, and the high valuations have been with the perceived high quality companies. So that is something that needed to mean revert, and we have seen some early signs of that happening. I don't think by any means that is over. So how do you deal with that, right? How do you deal with the P ratios coming down? Make sure that, firstly, you're not buying something which is obnoxiously expensive, right? Secondly, try to make sure that the earnings growth delivery that you get is good enough to compensate for the high Ps, because even if the Ps decompress and come back to mean levels the next 3 years, earnings growth should be high enough to compensate for that. And also, again, quality is a great defense against P compression, because all said and done, the P compression that can happen in a very good quality franchise with decent earnings growth is limited, right? Because longevity of the franchise is very high. So what is the P a function of? It is a function of ROEs, which is reflection of quality, the function of growth, and it's a function of longevity of that growth. So make sure that you're buying good quality, make sure that you're buying high growth, and make sure that you're buying longevated franchises. I think that is the ideal solution for a very high P situation. Even then, be careful, because sometimes the real problem could be that you could err on some of your assumptions on growth and longevity, even quality in some cases, because we live in an era of disruption, things change. So you have to be mindful of those changes. This is an environment where, we are buy right, sit tight people, but you have to be mindful of changes that are happening, and you have to make sure that you realign your portfolio wherever the changes are going to be massive and valuations are full or rich.
This is a question we keep getting asked, for someone who wants to invest in equities today, is this a right time? And for people who've just come in a few months back, they're obviously experiencing a lot of volatility in their portfolios. What would be your advice to them?
See, if your horizon is right, equity, the thing to remember about equities is that it's a very long duration product, right? It's not a 3-month product, it's not a 6-month product, it's probably not even a 1-year product. And especially when you come in when markets are richly valued like they are today, your duration has to go higher. Because what can happen when you come at valuations which are very high? Valuations can come down. But as I said, for valuations coming down, there's a compensating factor in equities, which is earnings growth. So if you increase your duration and your earnings growth in a portfolio is high enough, the earnings growth will compensate for any valuation decompression. So I believe that today anyone who has come into equities or is planning to come into equities, the ideal duration is 5 years or more. So, and if you come for 5 years or more, rest assured that you will, in a good quality portfolio, decent earnings growth, you will get higher returns to comparable.
So if your time horizon is right, you'll be okay.
Yeah, your time horizon has to be right. You shouldn't come into equities today thinking that you will make a high amount of returns over the next 6 months. That is a fool's game. That isn't something that you need to avoid. Come in with the right expectations. Come in expecting acceptable returns. Come in expecting a duration of 5 years, and you will be fine. That's
right. So Gautam, you have a experience more than a decade now in capital markets. What have been the important milestones in your career, or any experiences that you can share which have shaped your own personal investment philosophy?
So I came into markets with a passion for markets, but not a lot of experience of trading into stocks. What I came in, unlike many other people who come into markets in India, is with a degree in business and a liking for business analysis and some experience in that too. So I think that's remained my core. I still believe that at heart I'm a business analyst, and that's been the way I have operated. So I try to analyze businesses and take investment calls or decisions around that based on my business analysis skills. And somehow it fits into our style of investing also, because we are trying to gauge long-term prospects of individual businesses. Not only that, but sectors too, and within sectors maybe one set of companies versus another set of companies. So even in business school, what interested me most was strategy, valuations and marketing. So I tried to use that knowledge, that understanding in trying to decipher trends which apply for the sectors and for individual businesses within that, and hence be able to take long-term calls on such businesses. So that has remained with me, and that's pretty much how I have learned to operate in markets or in investing, right? So I think that fits in very well with our philosophy, how we invest here too. The second aspect, it was a bit unfortunate in hindsight, but as an analyst, my focus by default, because of whatever responsibilities I was assigned, for the longest time was on cyclical and deeply cyclical sectors, including capital goods, industrials, and so on and so forth. So that learning has taught me that the importance of buying compounding long-term franchises vis-a-vis the cyclical ones, because in cyclicals your knowledge or understanding has expiry period, it's limited shelf life. So either you make a ton of money very quickly and get out, or you can get caught on the wrong foot either side, getting in, getting out, and it's the value of that is limited. Versus if you can really focus on secular businesses, even in cyclical businesses, certain business models which are built on more secular trends, that is a much more longevated money-making franchise, and that's much more productive from your perspective. So that difference in my mind has been very stark, because I have seen the other side too. It's almost like being on the dark side and coming back, right? So that's a very useful experience, and after having analyzed cyclical sectors, once I started looking at more secular sectors, the difference for me was quite stark, and that has really helped me evolve more as a long-term investor rather than just focusing on the short term. Of course, the attraction of making a quick buck in a short period of time is something that kind of keeps coming back in people's mind, right? You cannot deny that, but I'm sure the core will always be long-term investing. So
right. So at Motilal Oswal, we put knowledge first, and I know that all of us are passionate about reading. Are there any key books that you'd recommend to our viewers to help them become better investors?
Yes, absolutely. Ashish, books that you read is a function of your stage of evolution in life, how much you have read already and all that. But for people who want to become serious long-term investors, assuming that you're young and you want to really become an investor, I think two books which really helped me in my understanding of business would be one on strategy, which is essentially Michael Porter, and the second would be on marketing, which is Philip Kotler. So combined, they give you a good flavor of how to analyze businesses. Good starting point there. Of course, you have to understand accounting and valuations and all that. For that, no specific book really matters. But beyond that, I think for every investor, Mr. Buffett's letters every year is a treasure trove. It's a must read. It's available in a book form too. There are multiple versions of it. So you should really read what his thought process has been, and it's also evolved over time, so that gives you different nuances about investing. Besides that, Mr. Munger's Poor Charlie's Almanac, that's a very good business on, that's a very thick read, but that's a good read on both investing as well as life. I think another author who has disproportionately influenced me has been Mr. Taleb. The first two books, especially Fooled by Randomness and Black Swan.
The guy who coined Black Swan.
Black Swan, yeah. So I think reading him gives you a very different perspective about risk and how we understand risk, even the psychology of investing. So that has helped me. That is a much more nuanced probably book, but that has really helped me evolve as an investor. I think Peter Thiel's 0 to 1 is another standout book for reinforcing your belief in investing in equities and so on and so forth. So quite a few books, but yeah, you learn quite a bit from all these authors. People like Michael Lewis or Barton Briggs are also important authors that you might want to read.
So Gautam, it's been a very interesting conversation. Thank you very much. We wish you continued success and continue making money for our clients. Thanks a lot. We were in conversation with Gautam Sinha Roy. This is an endeavor to bring you closer to our winning manager. So thank you for watching this edition of Know Your 4C Manager. For any feedback, you can write in to us on our email, follow us on Twitter, or watch our YouTube channel. Thank you very much.